Your 20s are full of milestones. Your first real job, first paycheck, maybe your first apartment, and definitely a lot of first-time financial decisions. But it's also a time when many people make mistakes that can seriously affect their long-term financial future, especially when it comes to investing. The truth is, your 20s are one of the most powerful decades for setting the foundation of wealth, thanks to something called compound interest. In this video, I'm going to walk you through 7 of the most common investing mistakes people make in their 20s, and more importantly, how you can avoid them. Whether you're brand new to investing or you've already dipped your toes in, this video could save you from years of regret. Let's start with the biggest mistake of all, not starting early. So many people say, I'll start investing when I earn more, or I need to focus on student loans first, or even, I'm too young to worry about retirement. But that's exactly why you need to start now, because you are young. The earlier you start, the more time your money has to grow. For example, if you invest just $200 a month starting at age 22, and it grows at an average of 8% per year, by the time you're 60, you'll have over $700,000. But if you wait just 10 years and start at 32, you'll have less than half that amount, around $300,000, even if you invest the same amount. The takeaway? Don't wait for the perfect time. Start with whatever you can, even if it's small. Another mistake that's super common in today's social media age is chasing hype. We've all seen someone on TikTok or Reddit say, "This stock is going to 10x," or "This crypto coin is the next big thing." And sure, it's tempting. You see people posting their screenshots of gains and you feel like you're missing out. But here's the truth. Investing based on hype, trends, or social media tips is not a strategy. It's gambling. The problem isn't just losing money, it's also building poor habits. When you invest in something you don't understand, you're more likely to panic and sell the moment it drops. Smart investors focus on fundamentals, diversification, and a long-term plan, not the next meme stock. Before you even start investing, you need to take care of one crucial thing, an emergency fund. This is money you set aside in a high-yield savings account, not in stocks or crypto, that can cover 3 to 6 months of living expenses. Why? Because life happens. You could lose your job, your car might break down, or a medical bill might pop up. If you don't have savings to cover it, you might be forced to sell your investments at a bad time, possibly at a loss. An emergency fund is your financial safety net. It keeps you from going into debt or panicking when unexpected expenses come up. Think of it as your financial foundation. You shouldn't build a house without one. Now let's talk about retirement accounts. I get it. Retirement feels like a lifetime away, but that's exactly why you need to start now. In the US, accounts like a 401k or a Roth IRA are powerful tools. A 401k, especially if your employer offers a match, is a no-brainer. That match is free money, seriously free. A Roth IRA, on the other hand, is great because your money grows tax-free and can be withdrawn tax-free in retirement. The key is to automate your contributions and treat it like a monthly bill to your future self. The earlier you start, the more time your money has to grow and the less you'll need to contribute later on. Another mistake that can cost you big time is not diversifying your investments. A lot of young investors go all in on one stock, one sector, or even one cryptocurrency. Maybe it's Tesla, or maybe it's Bitcoin. But what happens if that company crashes or that market takes a dive? If your entire portfolio is tied to one asset, your entire net worth goes down with it. Instead, you want to diversify. That means spreading your investments across different industries, asset classes, and regions. Index funds and ETFs are great for this because they automatically invest in hundreds of companies at once. Diversification doesn't guarantee profits, but it helps protect you when the market gets rocky. Let's talk about something most people ignore: fees. You might not realize it, but the difference between a fund that charges 1.5% in fees and one that charges 0.05% can add up to thousands, even hundreds of thousands, over your lifetime. For example, over 30 years, A high-fee mutual fund could cost you tens of thousands in lost gains. That's money that should be growing for you, not going to fund managers. Stick to low-cost index funds from reputable firms like Vanguard, Fidelity, or Schwab. Always check the expense ratio. Lower is better. Also, avoid constantly buying and selling stocks. Not only can it rack up fees, but it can trigger taxes too. Finally, one of the most dangerous mistakes you can make is letting emotions drive your investing decisions. The stock market will go up, and it will go down. That's normal. But if you panic and sell when prices fall, or you rush to buy when everyone else is hyped up, you're likely to lose money. Emotional investing leads to buying high and selling low, the exact opposite of what you should do. The best investors stay consistent. They invest automatically every month, whether the market is up or down. They trust the process and let time do the heavy lifting. Remember, wealth is built over decades, not days. Your 20s are the best time to start building smart habits that will pay off for the rest of your life. Avoiding these 7 mistakes can put you years ahead financially. Most people don't even think about investing until their 30s or 40s. By then, you've already won half the battle. If this video helped, give it a like, subscribe for more personal finance tips, and drop a comment below. What's one financial lesson you've learned the hard way? Thanks for watching, and remember, your future self will thank you for starting today.